To the show, let me welcome a very special guest who is joining us right now, not just known for his differentiated views on the market, but also holds very strong opinions. So let's try to get a benefit from his reading on the markets. And let me welcome Ashish Somaya, who is the CEO of Vito Capital AMC. Hi Ashish, good to be speaking with you. Ashish, first up, the narrative in the market has actually changed from like buy the dips. Now people are really questioning that whether to go ahead and buy or not. Help us with your reading on the markets. Given the correction, will you call out a bottom yet, or maybe we are near to those bottom levels, or is it still time to be a little cautious?
Yeah, thanks for having me. I think it's very difficult to call the bottom at any point in time. And if you really ask me, I think our problems didn't start necessarily with things closer to our shores. Our problems actually started right in early October. First, I think briefly there was a news of money being reallocated to, say, for example, Chinese markets. But then all along, it has been, more like a Trump trade. Appreciation in U.S. markets and appreciation in the U.S. dollar. Obviously, that has created headwinds, not only for us, but for most emerging markets. Relative depreciation in currencies, outflows, and underperformance. And then, of course, from December, January onwards, we also started hearing a lot about our own, economic performance and results and stuff. Now, from there on, if you really ask me, a lot of the trends have changed. I mean, RBI policy has changed, first of all. Liquidity, interest rates, lot of those things have changed. If you see, for example, even the dollar index, US yields. So my sense is that if you look for delta change or if you look for trend change, I think on the margin things are improving, and in the background our markets have corrected a lot, so they are not as expensive as they used to be. I've given you a long answer, but I think the trigger needs to come from outside, and I think somewhere in the next month or two, we will probably bottom.
Hi, Ashish. This is Ankita also joining in. Speaking of whether to buy or not, to what to buy. Now, if you look at Nifty, its 12-month PE is trading below 20x, which is much below its 5-year average. Whereas if you look at the mid cap and the small cap space, despite the correction that we have seen, it is still trading at a premium. So are you seeing value in the large cap names? If yes, then what are the sectors that you see value in, and is it really the time to now look at quality over momentum?
So, good points you made. I think this has been a trend over the last 6-7 months, more specifically, June 2024 onwards, post the election. One has really seen quality has been outperforming value. So, if you just look at any data, which is say 1 year, 3 year, 5 year performance, and you look at all the sectoral indices, what you will find is that on a 3 year, 5 year basis, all the cyclical, macro, policy-driven sectors, whether it's railway, defense, infrastructure, utilities, energy, all of those things on a 3 year, 5 year basis, they have been top gainers. If you look at it from 52-week highs, these are the ones which have fallen the most. On the other hand, what has been underperforming on a 3 year, 5 year basis is say financials, capital market companies, IT, selectively consumer, healthcare. A lot of these were underperforming. And now if you see the last 3 to 6 months, these are the ones which are actually outperforming. So we've been, last 3 to 6 months, we've consistently been calling out a rotation, and, quality versus value is one rotation. And apart from that, even there is sectoral rotation. And the third one clearly is a market cap rotation, because last 6 to 9 months, we all have been saying, not been giving any drastic calls, but always been saying that, rebalance your portfolios more in favor of large caps. You need to keep in mind, in the last 3 years, what has happened is that in everybody's portfolio, small cap has outperformed and cyclical value bias sectors have outperformed. Plus, people have a tendency that they keep investing more and more where there is outperformance. And then, you need to really rebalance the portfolio when there is a trend change. So I think last 3 to 6 months, this is what we've been communicating. And people still need to review their portfolios. If they are still sitting where the market was 2 years back, then they need to bring the portfolios back into the center of the market and bring it to the relative outperformers of today's time.
Well, Ashish, you have been quite vocal about the small cap space and why that space is something that really needs some caution, and believe that you don't have your exposure there. But on the mid cap space, Ashish, given the correction, like almost a double digit correction from those high levels, specifically on the index level, and the pain in the portfolio is even larger than that. Give us your sense on the mid cap space, that where do you see this particular area of the market headed, and any pockets of opportunity that you believe something that investors should look at?
Look, first on the small cap space, that's the happy hunting ground. See, we are basically bottom up stock pickers. We don't manage. I'll come to the fact that we don't manage a dedicated small cap fund, but we do have small cap exposure in all the mixed market cap kind of products. The reason is because if you see small cap as a space, it's very heterogeneous. The sectors which are the sectors which have a prevalence in this small cap space, all of those sectors are very heterogeneous. And if you see the sectors which have prevalence in the large cap space, say for example, the oil marketing companies, the big IT companies, big banks, commodities, energy, they are tandem sectors. They move in tandem. If one thing moves, everything moves. If they don't move, nothing moves. So it's very difficult to do stock picking, right? It's very difficult to do stock picking alpha in the large cap space. Whereas small cap, you take stuff like consumer discretionary, pharmaceuticals, chemicals, financial services, very heterogeneous space. And depending on what you buy, you can create alpha. So small cap is like a happy hunting ground for alpha generation. But we don't manage a dedicated small cap fund because we know that it's a narrow part of the market and extremely volatile. Once in every 5 years, you see a 30-40% drawdown. The money comes after the performance comes, and money is ready to go when the market falls 20-30%. So small cap really brings about the worst of investor behavior, if you really ask me. That's why no dedicated funds, but at the same time, for generating alpha, small cap is a great space to be in. And we still deploy like a 30-member team to cover a very wide base and do stock picking in small cap. I think that with this massive correction, I mean, the indices are 20 to 23% down, but there are so many. You take the entire capital market space, practically every stock is 45 to 50% down, right? And I really believe that, some of these wealth management companies, asset management companies, for instance, just taking one example, they're not as cyclical as is made out to be. Their earnings is not as cyclical as the stock market volatility is really. So that's just one example. I think, there is value emerging. And, that whole space is very important for generating alpha.
All right, Ashish, we are completely out of time for this one, but it was a pleasure to have you on the show and weigh in on how the markets are shaping up. We will let you go on that note.